Today we're looking at Alphabet or Google after what was honestly a very strong Q1 2026. And the big question here is pretty simple. Is Google still one of the best long-term AI compounders in the market? Or has the stock already priced in so much optimism that future returns might be a lot more limited? Because after this quarter, I think both things can be true. The business looks excellent, but the stock is no longer obviously cheap. Alphabet reported Q1 revenue of $109.9 billion, up 22% year-over-year. For a company already operating at this kind of scale, that is a very impressive number. Operating income grew even faster, up 30% to $39.7 billion, and operating margin expanded from 34% last year to 36% this year. So right away, that tells us something important. Google is not just growing, it is growing while becoming more profitable. That is exactly what investors want to see from a mega-cap tech company, especially one spending aggressively on AI. But there is one thing we need to separate out. Net income was $62.6 billion, up 81%, and diluted EPS came in at $5.11. That headline EPS number looks incredible, but a big part of that was helped by a $36.9 billion gain on equity securities, which added around 2.35 days to diluted EPS. So yes, EPS looked amazing, but we should not treat all of that as recurring operating performance. The actual business performance was still very strong, but the headline profit number was boosted by investment gains. Now, to me, the most important number this quarter was search. Google Search and other revenue grew 19% year-over-year to $60.4 billion. That matters because search is still the core economic engine of Alphabet. This is the profit machine that funds everything else: cloud, Gemini, YouTube investments, Waymo, and the broader AI build-out. And the big fear investors have had is that AI chatbots and answer engines could eventually disrupt traditional Google search. But at least this quarter, that is not showing up in the numbers. Management said AI experiences are driving usage, with queries at an all-time high. So the story right now is not that AI is destroying search. The story right now is that Google is integrating AI into search and still growing the core business at a very healthy rate. Now, does that completely remove the long-term risk? No, definitely not. Search behavior can still change over time. AI answers may cost more to serve. Ad formats may need to evolve. Competition is still real, but based on this quarter, the bear case that Google Search is suddenly falling apart because of AI just does not show up in the financials. The next huge piece of the quarter was Google Cloud. And honestly, this might be the biggest thesis-improving part of the report. Google Cloud revenue grew 63% year-over-year to $20 billion. That is massive growth. But the even more important part is profitability. Cloud operating income increased from $2.2 billion to $6.6 billion, and operating margin expanded from 17.8% to 32.9%. That is a huge step change. For a long time, Google Cloud was viewed as the third player behind AWS and Microsoft Azure. It was growing, but it was not really the main profit engine of Alphabet. Now, that is changing. Cloud is becoming a serious earnings contributor, and AI infrastructure demand is helping Google reposition the segment. The company has chips, infrastructure models, developer tools, and enterprise AI products. So Google is not just renting out compute, it owns more of the AI stack than most companies can. And the backlog number was also very important. Google Cloud backlog was more than $460 billion, nearly doubling quarter over quarter. Management expects just over half of that backlog to be recognized over the next 24 months. That gives investors better visibility into future cloud revenue. Now, backlog does not automatically mean profit. Alphabet still has to deliver, convert that backlog into revenue, and maintain margins. But it is a very strong signal that enterprise AI demand is real. Then we have Gemini and AI adoption. Alphabet said its first-party models, including Gemini, are processing more than 16 billion tokens per minute through direct API usage. That was up 60% quarter over quarter. Gemini Enterprise paid monthly active users grew 40% quarter over quarter. This is important because Alphabet is not only spending money on AI defensively, it is starting to show real usage, enterprise adoption, and early monetization signals. The key question is still whether that usage turns into durable revenue and strong margins over time, because usage is one thing, profitable usage is another thing. And that leads to the biggest trade-off in the entire quarter: capex. Capital expenditures were $35.7 billion in Q1, up from $17.2 billion last year. So capex more than doubled. This is where the story gets more complicated. The good news is that Alphabet is investing aggressively because demand for AI compute appears very strong. If cloud, search AI, Gemini, and enterprise AI tools all continue scaling, this spending could be very valuable. But the concern is that this business is becoming much more capital intensive. Operating cash flow was still excellent at $45.8 billion, up 27% year over year. But free cash flow fell 47% to $10 bud bullion because capex increased so sharply. So the income statement looks extremely strong, but the free cash flow profile is being pressured by AI infrastructure spending, and for investors, that is one of the most important things to watch. Alphabet is still a cash machine. Trailing 12-month free cash flow was $64.4 billion, but that was down 14% from the prior period, and it shows that AI spending is not just a small side item, it is now a major part of the financial story. On the balance sheet, Alphabet still looks very strong. The company ended the quarter with $126.8 billion in cash equivalents, and marketable securities. That gives it enormous flexibility. But long-term debt increased to $77.5 billion, mainly because Alphabet issued $31.1 billion of senior unsecured notes during the quarter. Now, I do not think this is alarming given Alphabet's cash generation, but it does show that the company is willing to use debt while funding this massive AI infrastructure cycle and other strategic investments. Another interesting piece is subscriptions. Alphabet now has around 350 million paid subscriptions across Google One, YouTube, and other products. That matters because Alphabet is slowly becoming less dependent on pure advertising. Ads are still the core business, but subscriptions can add more recurring revenue and improve business diversity over time. Then there is Waymo. Waymo crossed 500,000 fully autonomous rides per week. Now, Waymo is still inside Other Bets, and Other Bets remains loss-making. In fact, Other Bets' operating loss widened from $1.2 billion to $2.1 billion. So Waymo is not driving today's earnings, but it is one of the more interesting long-term call options inside Alphabet. If it scales successfully, it could eventually become a very valuable business, but for now, I would still treat it as optional upside, not the core reason to own the stock today. So when I put the business together, Alphabet's quality is very clear. Search is still growing. Cloud is accelerating dramatically. Margins expanded. AI adoption looks strong. The balance sheet is excellent, and Alphabet has distribution across search, YouTube, Android, Workspace, cloud, subscriptions, and developer tools. That combination is incredibly hard to replicate. But now we have to talk about valuation. At the current GOOG price of $347.31, Alphabet's market cap is around $4.19 trillion. The trailing PRE is around 34 times, with other public sources showing roughly 31 to 32 times depending on timing and share class. Either way, this is not a cheap stock. And that matters. A 30+ times earnings multiple for a company this large requires a lot of confidence. Investors are already pricing Alphabet like a company that can keep compounding earnings at a strong rate despite its massive scale. That is possible, especially if cloud keeps growing, AI monetization improves, and search remains durable, but it does reduce the margin of safety. The base case from the analysis assumes Alphabet can grow revenue at around 10% annually over the next 5 years, starting from Q1 annualized revenue of about $439.6 billion. That gets Alphabet to around $708 billion of revenue in year 5. Using a 27% net margin, that would mean about $191 billion of net income. With around 12.2 billion diluted shares, that comes out to estimated EPS of $15.67. Apply a 25 times terminal PE, and the projected share price is about $392. Compared to today's price of $347.31, that is only about 12.8% total upside over 5 years, before dividends. And that is the key issue. Alphabet can remain an excellent company, but if the current valuation already reflects most of that excellence, the stock return may not be amazing. In the bull case, things look much better. If AI becomes a major revenue accelerator, cloud remains one of the biggest AI infrastructure winners. Search AI increases engagement and monetization, Gemini becomes a major platform, and Waymo becomes more clearly valuable, then the numbers can work very well. The bull case assumes 14% annual revenue growth, a 30% net margin, and a 30 times earnings multiple. That gets year 5 revenue to around $846 billion, net income to about $254 billion, EPS to around $21.16, and a projected share price of about $635. That would be about 83% upside from today, so there is definitely a path to strong returns, but Alphabet needs to execute very well for that to happen. The bear case is also worth taking seriously. If AI raises costs, search faces more pressure, cloud growth slows after the AI infrastructure boom, and capex remains high, then free cash flow could stay under pressure. In that bear case, revenue grows at 6% annually, net margin falls to 22%, and the PE compresses to 20 times. That gets to a year 5 share price of about $204, which would be around 41% downside. And the scary part is that this is not some disaster scenario where Alphabet collapses. It is just a scenario where Alphabet remains profitable, but growth slows, margins compress, and the market stops giving it such a premium valuation. That is why valuation matters so much here. For next quarter, there are a few things I would really be watching. First, search growth. Investors need to see whether that 19% growth is sustainable or whether this was partly a one-quarter acceleration. Second, cloud growth and margin. Cloud is now central to the AI thesis. If growth remains elevated and margins stay above 30%, that would be a very positive sign. Third, capex and free cash flow. This is probably the biggest financial watch item. If capex keeps rising sharply, free cash flow could remain pressured even if operating income looks great. Fourth, Gemini monetization. Token usage and paid user growth are encouraging, but eventually the market will want clearer evidence that AI usage is turning into meaningful revenue and profit. And fifth, buybacks. Alphabet made no stock repurchases in Q1 2026. Given the stock's valuation and the company's capex needs, investors should watch whether buybacks resume or stay muted. So here is my overall takeaway. This was a very strong quarter for Alphabet. Search remained resilient, cloud accelerated dramatically, margins expanded, AI adoption metrics looked impressive, and the long-term thesis probably improved, especially because cloud is becoming a much more important profit contributor. But the stock is not obviously cheap anymore. At more than 30 times earnings and a market cap above $4 trillion, investors need a lot to go right. My view is neutral to moderately bullish. Alphabet is still one of the highest quality AI platforms in the market. But at today's price, I would describe it more as quality at a fair to rich price, not a clear bargain. So for me, the company looks better after this quarter. But the stock is valuation sensitive. And going forward, the entire investment case comes down to one question. Can Alphabet turn this huge AI spending cycle into durable revenue growth, stronger cloud profits, and healthy free cash flow? If yes, the stock can still work. But if AI mainly raises costs while growth normalizes, the current valuation leaves less room for error. That is what I'll be watching closely over the next few quarters.